Ladies and gentlemen, every quarter, SoFi releases their earnings in two parts. The first is the earnings results, earnings presentation, and call. And then the second is roughly about 2 weeks later, and this is their 10Q or 10K. This is the official form that gets sent to the SEC that's 341 pages long this time. This time it's the 10K because it's the annual report, and there ends up being a lot of additional information that you can end up finding in 341 pages of your favorite company. So in this video, I want to highlight some things that we are learning from the 10K that potentially we didn't end up seeing in the actual earnings release. Now, that doesn't mean everything in this video is brand new. There are some other slides that I ended up adding just because it adds context to the new information, but let's go ahead and go through. So first up on lending. What we end up seeing from SoFi student loans is that there was a massive increase in originations. We already knew this. However, the actual interest rate that we ended up seeing on this at 5.89% was higher than we saw in previous quarters and higher year over year back whenever it was 5.73%. We also saw defaults stay relatively in line with what we've seen previously at 0.7%. So student loans are doing fine and growing very well on originations. Home loans, massive acceleration in overall originations. Average interest rates ended up staying in line what it's been over the last year or so. And the amount of interest that they end up recognizing on these loans is skyrocketing extremely quickly. Last year, we only did $1.9 million. This time, nearly $18 million from home loans in terms of interest income recognized. Personal loans, by far the most important, ended up seeing roughly the exact same amount of originations that we saw last quarter. However, that was not Wall Street's consensus. Wall Street actually expected them to slow down on originations. They kept up roughly a 13% average interest rate that they earned, and defaults ended up staying extremely low at only 2.7%. Very, very good from SoFi on the personal loan side. Now, whenever we look at this default rate for personal loans, it's actually looked at in two different ways. One is if they essentially did not end up selling off 90 million of delinquent loans each and every quarter. This quarter was the exact same as previous quarters. And then the real rate after they sold off those highly delinquent loans at 2.77%, a very slight increase from the quarter before at 2.65%, but much better than a year ago. The average FICO score per loan, however, this is not, how SoFi ends up underwriting anyways, ended up seeing a little bit of a stark decrease for student loans. However, it's still 765, which is just going back to the sort of norm that we've seen previously. There was actually less of a drawdown from last quarter and more of a spike up in an anomaly that we saw in Q3 of 2025. Across home loans and personal loans, we actually did see a slight tick up, only about 1 point quarter over quarter, and a nice increase over the last 4 quarters for both. Now, all of these average interest rates that we're charging on these loans or average coupon rate ends up allowing us to see what their net spread is. If you know how much they're paying out in deposits and you know how much they're having to receive from their loans, we can sort of see what their take rate is. Now, this is not inclusive of default rates, but we're seeing roughly 7% now in their net spread, which is up quarter over quarter from 6.9% just previously, and relatively high over the last few years that we've seen, only passing that 7% mark a few times. Going back to personal loan originations, because this is the high majority of their overall loan activity, you can see how much the loan platform business has truly taken over. Over 47% of total personal loan originations are now originated for other institutions, which immediately means that once they get on the books, they're immediately sold. The blue bars here, which is SoFi's balance sheet personal loans, do not have to be originally sold. And so whenever we take a look at the full amount of loan sales for SoFi on the personal loan side, a large majority of that is the loan platform business, which are always sold. The remaining amount is how much SoFi is selling off of their balance sheet, which is very small now, which means they're actually keeping a lot of those loans. And a lot of that has to do with their tangible book value and how much they can actually house on their balance sheets. Another reason why that should be exciting is because they believe that those are really high quality loans, and so they can sit on them for a while. And so this is what SoFi's total loan portfolio looks like on their balance sheet. Roughly sitting at $37 billion, okay? An increase of roughly $3.3 billion quarter over quarter. A lot of that now in credit cards and a growing amount in home loans. but essentially it's growth across all segments, right? Diversified lending. If we end up taking a look at this as a percentage basis, you can see just how much student loans are growing as a percentage, how much credit cards and home loans are building up and actually diversifying away from what people would call SoFi as a personal loan lender. Of course, back in Q3 of 2023, you could absolutely call them a personal loan lender, but the percentage of their overall business being, let's say nearly 70% being all personal loans, now that's closer to being around 60%. A big decrease, and hopefully, if things go well, they'll continue to diversify into larger total addressable market products like home loans and credit cards. The total amount of interest that they're earning on their entire book over the course of the year is now at $842 million, which is also quite exciting. Another thing that's quite exciting is how much that they can continue to ramp this up. I know a lot of people have talked about the dilution, but honestly, I'm quite excited about it because the tangible book value per share, you can see, has climbed up dramatically, meaning that not only was that dilution accretive, but it also means that they can step up their amount of their loan portfolio even faster without having to sell loans, without the loan platform business even growing. And of course, I do believe that that still will, but it just goes to show you how many growth levers that they actually can still pull. And one of those levers that they can continue to pull is credit cards. Now reaching roughly 435,000 total issued credit cards, the amount of debt per credit card account is actually lowering, diversifying that risk across, multiple different lenders. But what does this do to actual default rates? Although they've been increasing their total amount of credit card loans outstanding, now passing $500 million, this default rate has gone from 16.4% down to only 4.1%. A massive difference in how their actual loans are performing. Essentially, it's been in free fall since Q2 of 2024, going from 13.8 to 12 to 10 to 9. Like, it's just gotten so unbelievably good. And now we're in an area where we don't even have to improve it from here. Doing 4% on an annualized basis is perfectly acceptable and puts us in great territory with other credit card lenders. SoFi's been talking about for a long time that credit cards has been, as a standalone product, still not profitable. I honestly don't think that they'll be able to talk that way for a very long time. If they can hold up these level of default rates at 4% or even below, it's going to become a very profitable product very quickly. Now, if I had to pick a red flag, it would be the growth in the credit card debts are actually coming in by far the lowest FICO bands that they offer. So right here under 640 is this yellow line here that breaks out all the way up to $100 million in total debt is coming from the lowest FICO band. Then what we end up seeing is this gray line here, this light gray and this light orange that's climbing very quickly, much faster than the other FICO bands, are the 640 to 660 and 660 to 680, which are their three most risky bands in all the FICO scores for SoFi are their fastest growers. That can be concerning. However, can't argue with the actual performance, right? You can't argue with success. Their overall default rates continue to fall. Maybe this is because they're offering, smaller credit limits to these people, and that's why we're seeing credit card debt per account fall and defaults are falling, but still something to keep an eye on. Now, business debt. Overall, what we're seeing is that they've gotten rid of their preferred shares, their overall charges for their other, convertible notes and revolving credit. These interest rates continue to fall as well. Everything's looking good there. The amount of actual business debt that we're paying for, not talking about warehouse facilities, not talking about deposits, this continues to fall now at the lowest range in this entire chart, only spending roughly $9.6 million paying to actually run the business. Now, in terms of running like the loans and future loan activity and everything like this ends up coming in the form of deposits in warehouse facilities. Warehouse facilities, they completely paid off. This was part of their dilution. I know people are worried about dilution and they're somehow concerned about this, but you're not seeing the benefits of what this actually gets us. It makes SoFi a stronger business. We saw that in tangible book value per share. Like, pay attention to the numbers, okay? You can't just pay all this off with no ability to raise cash. They needed to raise cash. They did it at a price that's way higher than the current share price today. So this actually allowed them to stop paying high debts, and this got rid of another large segment of their business where they were paying like $27 million a quarter. Essentially, that now just got wiped away. The deposits continue to grow because, well, deposits are growing on their business. More users are choosing SoFi to direct deposit to, and that's actually, how they're able to grow a lot of their other business practices. So that's going to continue to climb. But the fact that they got rid of their higher interest rate debts is amazing. And that's why they did that dilution. In other updates, I just wanted to quickly highlight once again, SoFi's website traffic hit an all-time high in January. This is leading to Q1 to be extremely strong as well. We've already covered this. However, the customer acquisition payback period for their new members that they end up seeing on the platform continues to lower. So not only are we getting more members on the platform faster than ever, but their ability to pay for a customer, which customer acquisition is falling, and then you're monetizing that customer at a much faster rate is an amazing combo. Hopefully we continue to see this fall over time, but this is absolutely headed in the right direction. It only takes 13 months to pay off a customer. This is way faster than a Block or Chime or any of these other businesses. I mean, this is doing fantastic. One other thing that I will show off, because I just haven't shown off my slide for this yet, SoFi continues to beat all expectations, okay? If the 10Ks continue to come in this way, if the quarters continue to come in, pile in, website traffic hits higher highs, all numbers are beating. I know it's hard to not focus on the actual price of the stock, but the stock will reflect how the company's underlying performance is doing over time. Right now, it might be in sort of the voting machine area where people are sort of taking their bets on what's going to happen in 2026. But if SoFi continues to do what they're doing, beating expectations quarter in and quarter out for every single quarter that they've ever had since being a public company, there's only one way that this company is going to go over time, and that's up. But ladies and gentlemen, if you guys like these quick updates, all you guys have to do is hit the like button down below. It really helps out the channel. But until next time, thank you all so much for watching. Really do appreciate your time, and bye for now.